Welcome back to the channel. We're thrilled to have you here with us today. Today, we're diving into some smart ways to park your money and make it work for you. Whether you're a seasoned investor or just starting out, understanding where to place your funds can make a huge difference in your financial future. Because let's be real, just letting your hard-earned cash sit in a checking account is like leaving it on the table at a casino. It might be safe, but it's definitely not multiplying. In fact, with inflation, the value of your money is actually decreasing over time if it's just sitting there. We're going to explore different options, break down the risks and rewards, and by the end of this video, you'll be a pro at parking your money for maximum returns. We'll cover everything from high-yield savings accounts to stocks, bonds, and even some alternative investments you might not have considered before. So buckle up, hit that subscribe button if you haven't already, and let's get started. First, let's talk about high-yield savings accounts. These are a great option for those who want to keep their money accessible while still earning a decent return. Unlike traditional savings accounts, high-yield accounts offer significantly higher interest rates, which means your money grows faster. Next, we'll dive into the world of stocks and bonds. Stocks can offer high returns, but they come with higher risks. Bonds, on the other hand, are generally safer, but offer lower returns. We'll help you understand how to balance these investments to suit your risk tolerance and financial goals. Finally, we'll touch on some alternative investments like real estate, peer-to-peer lending, and even cryptocurrencies. These options can diversify your portfolio and potentially offer high returns, but they also come with their own set of risks. By the end of this video, you'll have a comprehensive understanding of where to park your money to achieve the best possible returns. So, let's dive in and start making your money work for you. First up, we've got high-yield savings accounts. Now, these aren't your grandma's savings accounts that offer a measly 0.01% interest. No, sir. High-yield savings accounts are like the cool kids on the block, offering significantly higher interest rates, sometimes even 2% or more. That means your money is actually growing while it's just sitting there. Plus, they're FDIC insured, so your money is safe and sound, even if the economy goes haywire. Think of it like this. You're basically getting paid to save money. Who doesn't love free money? Next, we've got certificates of deposit, or CDs for short. These financial instruments are a popular choice for those looking to save money with a bit more structure and security. Now, CDs are like the marathon runners of the savings world. Just as marathon runners commit to a long race, when you invest in a CD, you're committing to leaving your money untouched for a set period. You lock your money in for a fixed period, ranging from a few months to several years. This period is known as the term length, and it can vary depending on the financial institution and the specific CD you choose. In return for your commitment, you get a guaranteed interest rate that's usually higher than a regular savings account. This means your money will grow at a predictable rate, providing you with a sense of financial security. The catch? You can't touch your money during that time without paying a penalty. This penalty can vary, but often involves losing some or all of the interest you've earned, and sometimes even a portion of your principal. But hey, think of it as a forced savings challenge. By locking your money away, you're less likely to dip into your savings for impulsive purchases, helping you stay on track with your financial goals. It's a great way to grow your money if you've got a long-term goal in mind, like a down payment on a house or your dream car. CDs can be a powerful tool in your financial arsenal, helping you achieve those big milestones. There are different types of CDs to consider, such as traditional CDs, jumbo CDs, and even bump-up or step-up CDs, which allow for interest rate adjustments during the term. Each type has its own set of benefits and potential drawbacks, so it's important to do your research or consult with a financial advisor to find the best fit for your needs. When choosing a CD, consider factors like the interest rate, term length, and any penalties for early withdrawal. By carefully evaluating these elements, you can select a CD that aligns with your financial goals and maximizes your savings potential. Ultimately, CDs can be a rewarding way to save for the future. With the right strategy and a bit of patience, you can watch your savings grow steadily over time, bringing you closer to achieving your financial dreams. Now let's talk about stocks. Stocks are one of the most popular investment options out there, and for good reason. They offer the potential for significant returns, but they also come with their fair share of risks. Understanding how stocks work is crucial for anyone looking to invest in the stock market. Stocks are like the adrenaline junkies of the investment world. They can provide thrilling highs when the market is up, but they can also lead to gut-wrenching lows when things take a downturn. The excitement and potential for profit are what draw many investors to stocks. They're all about potential high returns, but they also come with higher risks. The stock market can be volatile, with prices fluctuating based on a variety of factors, including company performance, economic conditions, and investor sentiment. It's important to be prepared for these ups and downs. When you buy a stock, you're essentially buying a tiny piece of ownership in a company. This means you have a stake in the company's success. If the company performs well, its stock price is likely to increase, and you can sell your shares for a profit. However, if the company struggles, the value of your investment may decrease. If that company does well, its stock price goes up and you make money. This is the ideal scenario for any investor. The key is to identify companies with strong growth potential and sound financials. Doing your research and staying informed about market trends can help you make better investment decisions. But if the company tanks, well, you guessed it, your investment takes a hit. This is the inherent risk of investing in stocks. No investment is without risk, but stocks can be particularly unpredictable. It's important to be aware of this and to have a strategy in place to manage potential losses. The key here is diversification. Diversification is a strategy that involves spreading your investments across different assets to reduce risk. By not putting all your money into a single stock or sector, you can protect yourself from significant losses if one investment performs poorly. Don't put all your eggs in one basket. This age-old advice is particularly relevant when it comes to investing in stocks. By diversifying your portfolio, you can mitigate risk and increase your chances of achieving more stable returns over time. Spread your investments across different companies, industries, and even countries. This global approach to diversification can further reduce risk and open up new opportunities for growth. By investing in a variety of assets, you can build a more resilient portfolio that can weather market fluctuations and help you achieve your financial goals. Now, while stocks are out there living life on the edge, bonds are like their more stable, reliable counterparts. Bonds are essentially loans that you give to governments or corporations. In return for lending your money, they promise to pay you back with interest. Bonds are generally considered less risky than stocks, but they also offer lower potential returns. Think of them as the Robin to your stock market Batman. They balance out your portfolio and provide a safety net in case things get, well, volatile. Chapter 5. Real estate: building your empire brick by brick. Let's talk about real estate. Now, real estate is like that classic car you restore and it just keeps appreciating in value. It's a tangible asset with the potential for long-term growth. Plus, you can live in it, rent it out for passive income, or even flip it for a profit. Of course, real estate requires a significant upfront investment, and it's not as liquid as stocks or bonds. But hey, they're not making any more land, are they? Chapter 6. Peer-to-peer lending: be the bank. Ever wanted to be the bank? Well, with peer-to-peer lending, you can. It's like playing matchmaker, but with money. You lend money directly to borrowers through online platforms, cutting out the traditional banks. You get to choose who you lend to and set your own interest rates, potentially earning higher returns than traditional savings accounts. Of course, there's always the risk that borrowers might default on their loans. But hey, that's why it's important to do your research and diversify your lending portfolio. Chapter 7. Mutual funds: investing on autopilot. Finally, we've got mutual funds. Mutual funds are like the all-in-one package of the investment world. They pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. The best part? They're managed by professional fund managers, so you don't have to be a financial whiz to get started. Plus, they offer instant diversification, which is great for beginners. Just make sure to do your research and choose a reputable fund with a solid track record. Outro: level up your finances. Thanks for watching. If you found this video helpful, make sure to hit the like button and subscribe for more financial tips and advice. Remember, the best way to grow your wealth is to be informed and make smart decisions. So keep learning, keep exploring, and keep that money working for you. See you in the next one.